ESG investing has come from nowhere to become a trillion-dollar industry. It's shaken up the investing world and turned it upside down by helping investors put their money to work in only companies that uphold strong values. Now, while that might sound great to a lot of people who are trying to be a lot more conscious about how they spend their money, there are some downsides to this, and the cracks are starting to show. In fact, for the first time since inception, ESG-related funds are now starting to see money being pulled out, even during this bull market. So, what's going on here? What's wrong with ESG? And is this the future of investing, or just another way of the industry to make more money from you? Now, over the last couple of years, I've had quite a few comments on ESG investing, and I've often been asked what I think about different funds that people have invested in. So I thought it was worth doing a bit more of a deeper dive into this part of the investing world and see if most of us are missing out. First up though, let's actually define what ESG means, because I think this will lead us nicely to one of our first problems that we need to get stuck into. ESG stands for Environmental, Social and Governance. The idea is that other than just a company's financial position, which you can look at in their financial statements, businesses should be also held accountable and report on environmental, social and governance issues. Inside each of these themes are many different sections. For example, under the environmental theme, a company might get an ESG score based on how they use global resources like fossil fuels and water. Under governance, this could include how transparent a company is on its tax affairs and how diverse its management is. And under the social theme, a score could be given for staff safety and upholding human rights. There's loads of other individual areas that you can look at, and this is where the first issue comes in, because there isn't some kind of internationally agreed ESG definition. Multiple companies provide ESG data in the financial services world, and each of them have their own way of scoring and grading different companies. For example, some of them might provide you with a score out of 100, and others might give you a grade like you get from an exam at school. Let me show you what I mean if I just try and get some publicly available information from a couple of providers of ESG data. Let's take Shell, the global oil and gas company in the energy sector. For some people, you might think a company like this would be excluded immediately from an ESG index fund, as it's clearly in a sector that you might consider to be harmful. However, you could also argue that companies in this sector are also going to be in the best position to transition to clean energy, as they have all the resources and infrastructure to do it. So here's what a couple of the major ESG data providers think. If I look at Shell's ESG score on the London Stock Exchange website, they have an overall score of 92 out of 100, and they say that Shell is ranked the highest out of 405 oil and gas companies that they track. You can see here that in each of the sections across the environment, social and governance, they score really highly, even getting 100 on their resource use. What that means in reality, you'd have to dig a lot more for the details. It does say here that this is based on Shell's self-reported data from 2022, so to what extent they're marking their own homework, I have no idea. Now, just for reference, let me take you over to another ESG data provider here called Sustainalytics, which is part of Morningstar. If I also search for Shell, I get this page, and they have a scoring system here where the higher the number, the riskier the company is from an ESG perspective. As you can see, they have Shell here with a score of 32.4, and it's sat in the high risk category. They also rank it 52nd out of 309 companies in the oil and gas sector that they collect data on. If you also scroll down a bit further, you can see that they rank the management strong on their ESG risks, and clearly they have their exposure to ESG issues as high. Now, as an investor who hasn't got all day to look through all of their reasonings and methodology, how are you meant to make a decision about what companies to invest in? These are just two providers of data, but there are many others, and each of them will have their own opinion on where the different companies sit. Also, it's worth saying that ESG scoring is done on a comparative basis. This means that one score from one company can't be compared to another one in a different industry. Unfortunately, it's not just that simple. So if you were looking to pick your investments based on these scores, be careful about what data you're basing those decisions on and consider where that data is coming from. A lot of this relies on a company reporting their own data to the market, so make of that what you will. So yes, there's lots of differences in the way companies collect this data and report on it. But generally speaking, if you just want a basic index fund with an ESG spin on it, they'll mostly agree. For example, you're not going to go and see companies in the firearms business, nor will you see anyone in the tobacco production business or companies involved in nuclear weapons. This leads us on nicely then to the next point I wanted to talk about. As I mentioned at the start, ESG investing has risen rapidly in popularity since it became mainstream in 2019. However, it's only been very recently that this growth has stalled and investors have started pulling their money out. Here's some data showing inflows into ESG funds since 2019, up until just about a month or so ago. As you can see, there was a huge rise during the crazy bull market of 2020 and 2021, some cooling off during the pullback year of 2022, but then pretty much flat since 2023, and a little bit of a slight decline now. I think you can go through a whole number of reasons why this might be the case, but performance surely can't be the issue, as right now in 2024 alone, we're up 15% year to date on the S&P 500, and by all measures, everyone is pretty bullish. So what else is happening, and has ESG investing just run out of steam? Looking at some really popular ESG funds, I can't see anything that would suggest that this pullback is based on the performance of the funds on their own. For example, have a look at this chart. I've just pulled a really popular global ETF that many of you will know already, Vanguard's FTSE All-World Fund that trades by the name of VWRL. I then added on a couple of popular ESG funds, V3AM, which is Vanguard's ESG Global All-Cap Fund, and then I've also grabbed a similar fund from Xtrackers, which is their MSCI World ESG Screened Index. Now, as you can see, V3AM does have a slight lack in performance, but then we can only go back until 2021 when this fund was created, so this isn't really a super long-term chart. And then secondly, this Xtrackers fund is pretty much neck and neck with the global fund, so surely you would have to assume that investors aren't pulling their money out of these type of ESG funds. One area I do suspect might have something to do with it though is around the clean energy sector. You see, during the crazy bull market of 2020 and 2021, this area went crazy, but has since fizzled out massively as investors piled into these funds looking for great returns. For example, let me show you the performance of a really popular clean energy ETF that invested in companies in solar, wind, and other renewable energy companies. If I take the long-term chart on its own, you can see that this fund, iShares Global Clean Energy ETF, went crazy during the bull market. Since then, it's had a much harder time, and then if I add this one on to the last one, you can see now how just the difference in performance has been. Unfortunately, I suspect that areas like this have put a lot of investors off as they've chased the performance of the hottest areas and are now probably running into areas like AI instead, but hey, could be for a huge number of reasons. Now, speaking of performance and the growth of ESG, when researching this video, I wanted to see if there was any evidence that ESG investing was actually having any positive outcomes. After all, that's what this thing is all about for most retail investors. You want to know that your money avoids those companies causing harm in the world, and therefore you might assume that this pressure forces them to make changes. Likewise, if more of your hard-earned money goes into better companies, you might expect that these businesses might be able to accelerate their positive work. I found this paper here called ESG and Financial Performance that claims to look at some of the results over 1,000 studies looking at ESG funds and their outcomes. In their summary points, they seem to be persuaded that ESG investing can have some positive outcomes for your portfolio as a retail investor. For example, they say here that ESG investing appears to provide downside protection, especially during a social or economic crisis. They point to one example of German green mutual funds delivering better risk-adjusted returns during the global financial crisis. And then a second example of FTSE4Good, which is an ESG stock market index that performed better and recovered quicker its value after the same global financial crash. They also add another point here saying that companies that have sustainability initiatives appear to drive better financial performance due to improved risk management and more innovation. I think this might be a little loose on the analysis front, and it's very hard to separate all of the factors involved in the price of a company on the stock market, but it is still worth paying attention to. I'll also add that ESG funds can appear to perform well during downturns, as they exclude companies that might rely heavily on the prices of commodities. Just think about how during the pandemic, oil and energy stocks fell hard and took a long time to recover when compared to the rest of the funds in the market. In some ESG funds, they would have avoided all of those types of companies, and this would have really helped their performance. In another report from the insurance and investing company AXA, they surveyed 12,000 consumers to ask about their views on ESG. They found some interesting information, and one of the key takeaways was that 68% of the people that they asked said that they think their ethical views are important to consider before investing. They also added here that 31% of their investment holdings were either ethical or ESG in some way. A second really interesting point was that only 37% of investors expected an ESG fund to perform well compared to a non-ESG fund. This is quite an interesting point to read, as this shows that some investors are happy to underperform with their investments and will sacrifice returns for a better ethical outcome. They add that 60% of investors would be willing to pay higher fees to invest in an ESG fund that combines positive returns with ethical management of businesses. Now, that is certainly something that will make every fund manager lick their lips. There's nothing like your customers telling you that they're happy to pay higher fees if you can come up with a product that meets their needs. Now, just on that note about fees and costs, we do have to remember that all of this ESG data and screening does take time to be collected. And ultimately, these costs will fall back to you, the retail investor, to pay them. If you want to pay them and money keeps flowing into the ESG funds, then the industry will keep feeding you the information that you want. After all, this is what keeps them in business. If there is a demand for funds with the ESG brand in their titles, you can be sure that the investing industry will give you as many as you ask for. Now, speaking of investing and business, what does the big man himself think about ESG? Why don't we listen here to Warren Buffett and the late Charlie Munger on their thoughts about the ESG world from a year ago. Warren and Charlie were asked here what they thought in response to a comment made by Larry Fink, the CEO of BlackRock, that companies in the future will be valued differently than they are now based on their ESG scores.
In reality, we measure up well, but we don't participate in preparing reports for anybody that asks about it. And we have this idea that even though all shareholders are equal, we prefer individual shareholders. We actually prefer people we know as co-owners, and we don't want to be preparing a lot of reports and asking 60 subsidiaries each to do something where they'll set up a team and then mail things to headquarters, and then we'll supply them to somebody who, if our stock goes up some, is probably going to sell it anyway.
Well, they do make some really interesting points here, don't they? Putting together data for someone else to collect will cost a lot of time and money that ultimately has to come from somewhere. If you run a good business, you would expect that the first duty is to manage that money well and not spend it on things that aren't necessary. After all, isn't it the duty of management to produce the best returns for shareholders from a financial perspective? It's a really interesting area, I think, this one, and I do still think that it's very early days for ESG and what's ahead. One thing's for certain though, and it's that it's going to continue to be a very bumpy ride as the industry gets to grips with what it is and what its real goals are. Going back to Larry Fink, who we just mentioned, he's now said that the phrase ESG has been weaponized by opponents in the US. They say that ESG is a way of forcing values onto companies by applying pressure from big asset managers who often hold shares on behalf of retail shareholders. ESG might well become such a divisive topic that many investors just avoid it for that very reason, but I suspect that ultimately what will really matter is performance. The big question for me, and this is something I'd love to get your comments on too, is how much are you willing to pay for ESG, and do you think the current market of products meets your needs as an investor? Now, for what it's worth, when people have asked me before in the comments section about what I think about ESG funds, this has always been my answer. Personally, I'd rather just own a low-cost global index fund and let the market take care of itself. I'm not really sure on the impact that you can have as a small investor by excluding certain companies or areas that you might not like. Also, it's such a subjective topic as you're likely going to have different views on what is and what isn't acceptable. For example, let's just say you have a nuanced view, something that's quite rare these days. You accept the need for big oil and energy companies, but you want them to accelerate the move to renewables. Now, do you invest in them or not? If less people invest in them, then you can argue that this increases their cost of capital, meaning that those big investments could be less likely to be made. On the other hand, you might have more of a clear-cut view and think that ESG funds aren't going far enough to meet your needs. One thing I can be certain of, though, is that if there's a market for it, the financial world will give you the products you want. It's the same with any trend or current theme, whether it's AI, chips, robotics, or electric cars. If it's popular, the investing world will give you all of the funds and products you could imagine. Just remember that their business is in collecting fees from you, and anything that sits outside of a boring old index fund allows them to collect a premium. It doesn't matter whether a fund performs well or not over the next 10 or 20 years. All that matters is getting more and more money inside of it to collect those fees. So just be really careful when it comes to deciding where to invest your money and make a choice that works for you. Remember, I'm not a financial advisor and I never claim to be one. Now, if you do want to get yourself started investing though, I do keep the links to the brokers that I use in the description below. There's some free shares or cash up for grabs, so check those out and make sure you read any terms and conditions as well. So in conclusion, is ESG a waste of money for investors? I'm not so sure yet. We'll have to wait and see, but I'll be sticking with my boring old funds for the time being. And if I want to have an impact on the world, I'll do that by being careful with exactly how and what I spend the rest of my money on. Let me know what you think in the comment section down below. I'll see you in the next video. Happy investing.